Hello and welcome to Week 4's lecture on the conduct of business and the way that they should treat their customers throughout their life cycle of the relationship. But what you will realise at the end of this lecture is that really, from a regulatory point of view, we use the word client rather than customer. So far, we've covered what is regulation, the differences between types of regulation, the role of a conduct authority and a prudential regulator. And then we've looked at the conduct of individuals within a firm. Now we're going to look at the conduct of the firm as a whole and how they treat their customers or clients. So in this week's lectures, we're going to look at how we categorize clients, and this is from a regulatory point of view, how the conduct authorities categorize different clients and the levels of protections that different clients need. We're also going to look at financial promotions and look at how firms should conduct themselves when dealing with customers and the selling of products. Because as I've mentioned in a number of our face-to-face sessions or online sessions, really the role of an advisor is also a selling job. They're effectively a salesperson. But how do you do this with the client's interests in mind? And this comes back to one of the key rules from the conduct authority, and that is treating customers fairly. And we'll explore that as well. For more information on the content that we're going to cover in this week's lectures, you can view the Conduct Authority's Handbook, which demonstrates how individuals should act in the sales process. But we can also look at the Conduct of Business Sourcebook, and this gives guidance on how firms as a overall should work in the client's interest. So let's start with something commonly known as TCF, treating customers fairly. So what does this actually mean in practice? Well, the idea is it doesn't matter if if we're talking about retail clients, it doesn't matter if they are a high net worth individual or someone on a lower income. You have to treat these people equally. Of course, you might think, well, firms might give extra incentives or extra care to their clients of higher wealth, but ultimately, from a regulatory point of view, they shouldn't. And this is where lines can get a little bit blurred, because what is a customer relationship and how does that differ depending on the scale of wealth and how you treat customers? Is it fair or not? But that's kind of a blurred line between treating customers fairly and, I suppose, building up relationships with your customers or clients. And that's where things can get tricky. But a way around this is during the sales process, whether they're a high net worth or lower income customer, you treat them equally in the fact that you give them exactly the same information and go through the exact same process. The kind of building up relationship bit sits outside of the kind of sales process from a regulatory point of view. One of my previous examples in one of the online sessions was during the mortgage advisory process. As a mortgage advisor, when we sold the mortgage or advised on the mortgage product, we had to go through every single client and advise them on life protection to go alongside the mortgage. Now, a cynic, including myself, was thinking, well, is that not us just trying to sell an extra product? But because we're treating customers fairly, we had to make sure everyone was fully aware of the products available to protect, say, like the mortgage payment or the loan value in the event of death. And that didn't matter if it was a 20-year-old client or a 50-year-old client. Obviously, the costs of the products changed drastically. Even if some customers already had protection in place, you still had to mention it. And that was to ensure that you gave the same message to every single customer. But yes, a couple of customers did think it was a add-on kind of upselling sort of scenario. But from a regulatory point of view, we had to cover it. Or at least if the customer didn't want to engage in the conversation, we still had to provide them the information in writing for them to look at, whether they choose to or not. So as mentioned slightly before, what on earth is the difference between a client and a customer? They're very regularly interchangeable. If you look at this slide, and these are the principles of business which we will have seen earlier, which refer to the interests of the customer. But notice how you've got customer and client potentially used in the same sentence or in the next principle. They're very interchangeable. So how do you think you would describe the difference between a customer and a client? Some might say it depends on the relationship. Say if you go into a supermarket, you walk around, you pick stuff off the shelves, you go to the till, you go through. And technically, there's not much interaction there. You're just a customer of that business. But if you were going to a high-end fashion outlet and you had a personal shopper for you, then that personal assistant would not call you their customer. They'd call you a client. You're their client. You're doing their personal shopping for them. Because you've got that sort of relationship. So that's one way of looking at it. There's also an element of level of sophistication and knowledge. So at the lower scale of sophistication, like a current account, then you might actually just be a customer. But when you're talking to customers about sophisticated products or long-term debt like a mortgage, then you can start becoming more of a client because the relationship and the product that you're selling becomes more sophisticated and requires a larger level of knowledge sharing, and certainly from the advisory point of view, informing your client. And what you may notice through these principles here is from a conduct authority regulatory point of view, a customer tends to be a kind of a group within the term of client. So the regulators tend to use the word client overall, but customer is kind of a subgroup of clients. An example of an interesting relationship could be in the mortgage advisory process, because the customer might go to an intermediary, a mortgage broker, who will then deal on your behalf with the bank when putting this mortgage into place. So the person who's getting the mortgage, they're a customer of the intermediary. Then the intermediary has to work with the bank. So the intermediary is the client of the bank, but the person is customer of the client. So if we look at principle 8 here, for instance, this is where it really is interchangeable, and it might be a bit difficult to get your head around. And hopefully when we go through how you categorize different people in what level of either client they are, hopefully that will make more sense. But always think of that example in the back of your mind. A customer has gone to an intermediary, and then that intermediary is a client of the bank. And that's due to kind of the level of sophistication and scale of the relationship. So, from a regulatory point of view, what do they class as a client? Now you may think that a client is someone that they have a relationship and do business with already. But the regulators do add on that it is the intent to provide. And this is where the rules regarding financial promotion come into place. Because anyone that potentially sees a financial advertisement could become a retail client. And therefore you need to advertise correctly to your clients, as you may eventually provide a service to them. So potential clients are also counted from a regulatory point of view when it comes to the selling process. But also the regulators cover agents of a firm that may act on clients' behalf. Therefore, firms can't get around treating customers fairly if they have agents working on their behalf, and that the agents also fall under the realm of treating customers fairly, and that the firm and bank is also responsible for how their agents act on the firm's behalf when dealing with customers. And that's also kind of in the intermediary process, such as brokering. Now, how do the regulators classify different clients? And why do they classify different clients? Well, it's all about levels of knowledge and protection. And conduct authorities tend to provide this broken down into 3 elements. You have retail clients, professional clients, and what is known as legible counterparties. If we're going to use the word customer, you'd potentially say 1 and 2 on the slide are customers, but you would never call legible counterparties as customers. Because as we go from 1 to 3, the level of sophistication and the protections required is much less. But it always surrounds the level of protection needed. So from a regulatory point of view, the retail clients need the most protection and need to be informed the most about products they're going to use. I hope this traffic light system slide gives you a better understanding of the levels of protection needed. So a member of the public being a customer, or as the regulator points out, a retail client, their knowledge levels are to be assumed as quite low. Therefore, when you're selling financial products to them, you need to give them the most protection. You need to give them the most information as possible and help them in the decision-making process. But as you go up the level of client to professional client, then these clients are assumed to have more knowledge, therefore they're not as, I'm going to use the word needy, when it comes to selling, and they should be potential professionals themselves with the appropriate qualifications, thus you don't need to give them certain information. And then at the higher end, the eligible counterparties, then they're technically same size organisation or even a superior body. So if I go through examples of what these different clients are. So a retail client, as I say there in the final column to the left, this is the average member of the public. Your professional client would tend to be an intermediary, like a broker. So this could be an independent financial advisor, like one individual, or it could be a small firm or small business that conduct advisory on a whole of market basis, and they can potentially have access to products from various different banks and provide a whole of market advice. So professional clients tend to be smaller businesses that act on, we'll say, a retail client's behalf. And then eligible counterparties is very broad. So this could be from other financial institutions. It could be up to supranational elements. So it could be eligible counterparties are governments. They could be the EU, the IMF, and quite frankly, the likes of the government, EU and IMF are actually above the FCA's powers in the UK. So eligible counterparties potentially are above financial regulators when it comes to statute law. So as you can imagine, as we go up the scale of client, then really it's assumed their knowledge levels or own statutory power is greater. Thus, they have the ability to make their own decisions. So let's look at this in a diagram to summarise how we classify clients. Now you'll notice the words at the bottom there, per se and elective. I'll explain what that means in a second. But essentially, customers can move from left to right on this diagram. So people might start out as a retail client, but then they could eventually become a professional client. And then in some cases, you could move up to a legible counterparty depending on your size. But what I put in the yellow box there is these may be called a customer, and this is where it's quite interchangeable. But you're unlikely to call the likes of a regulator or the government or a higher regulatory body a customer in the form of elective counterparty. So what does elective and per se mean? Well, We'll start with retail client. You are per se a retail client. By definition or by characteristic, you are a retail client. You've walked in, you bought a product off the shelf. Therefore, per se, you are that. Professional clients. You can say per se, you are a professional client. You are a brokerage. You're regulated by the FCA yourself. You're a certain size. You're acting on behalf of retail clients. Thus, per se, you're a professional client. You know the rules and regulations. Therefore, you don't need as much protection because you should know how to conduct your business anyway. And you're probably authorised through the principles of good business. But this is where the elective bit comes in. You can, like I said, you can potentially move from left to right on this scale. If you're an individual advisor, an independent financial advisor, then to start with, you could be a retail client looking at the various different products that you want to advise your customers. But if you grow in size and you gain the necessary financial qualifications to give advice, you have a number of customers yourself, and you're in a place where you can advise individuals and help them purchase products, then you can start to elect to become a professional client. So you can go to the conduct authority and say, I now want to be treated as a professional client because I have this certain level of skill, knowledge, and I can advise others. Therefore, you can elect to move to the right. We'll cover very shortly why you might want to do this, but you couldn't potentially move from right to left. The only potential instance where you might go from being a professional client back to a retail client is if your CPD, continued professional development, was lax, you failed to do that, or potentially you were an independent financial advisor but your business folded, or in the worst case you had your license removed from you, therefore you would potentially go back to a retail client. But it is unlikely to go from right to left. So why would you want to actually move up and elect to be a professional client rather than a retail client? Well, it really comes down to speeding the process up and less red tape. And if you were potentially a financial advisor as an intermediary and you worked with an intermediary within a firm, then technically you're on the same level of knowledge and sophistication. Therefore, you wouldn't want to be patronised by this other advice going, yeah, well, I know what you're talking about, mate, because I do this myself. So that's when you would potentially want to move up. Therefore, you wouldn't have to go through the regulatory process of getting all the information from the firm. But obviously, it would be your role to pass all that information on to your retail client or customer that you're working for. So it is all about red tape. And the higher you go up, then the less you need to be informed, and potentially the less paperwork that you have to receive from firms when it comes to advisory. So just to recap, the differences: professional clients tend to be small firms who are also meeting the principles of good business and have the relevant qualifications and expertise to advise clients on larger firms' behalf. The eligible counterparties are there per se, normally due to their size and their current regulatory status. In some instances, where the likes of an independent advisor could potentially start running a small firm or a small business and then become a mortgage broking company, then obviously that mortgage broking company can get to a certain size where they start becoming more of a financial institution and broaden out or branch out or do merger and acquisition, then technically that could eventually elect to be an eligible counterparty as it grows from one individual to a large-scale business. But it's also worth noting eligible counterparties does include the higher skilled and levels of government and higher regulatory bodies. who might supersede the likes of the FCA's regulations. And the retail client is really everyday member of the public who needs as much advice and informed about the risks as possible. So, how do we actually move up from a retail client to a professional client during the elective process? So, as we mentioned before, it's all about the levels of sophistication and knowledge. And this can be tested in two ways. So there's the qualitative element or the quantitative element. So if we look at the qualitative, this is subjective and based on pure judgment. You can obviously demonstrate your expertise and experience through case studies, through qualifications, and continued professional development. So if you have all that in your portfolio, then of course you potentially would say, I have the qualifications and knowledge to advise retail clients. But then there's also the quantitative side. So if you're moving up the scale from being an independent advisor to being more of a business, employing other people, then of course it could be based on how many transactions you do, how many retail clients you have, and it could also be the potential size of your portfolio. But there will always be that level of judgment, because you may be a financial advisor with the elementary level of qualification required to give financial advice, but then potentially you could have customers of very high net worth. Therefore, the amount of money you actually deal with or advise on could succeed this lower limit, but you may not have the knowledge and the expertise to actually say you're an elective professional client. So there is a bit of a trade-off. Just because you might have lots of assets under management, you may still need to demonstrate a longer experience and gain higher qualifications to demonstrate that you are not a retail client anymore. When it comes to eligible counterparties, I've broken down the list here just so you can see what we mean by per se. And as I mentioned before, it might include governments, supranational organisations, that's the likes of the EU or the International Monetary Fund. But you can imagine from this list that these are firms and bodies that really are supervised by the likes of the PRA already. Therefore, they're the ones that are dealing with professional clients and retail clients already. Thus, if two big financial institutions deal with one another, they are clients of each other, but they don't need to inform them of said risks because they already know it given their size and sophistication, and that they follow the principles of good business. So, given my example before, how do you get up to being an eligible counterparty? So I said that you could potentially be an independent advisor, become a business, get to a certain scale, going through the qualitative and quantitative test, but then potentially you might get up to being an eligible counterparty through, organic growth or mergers and acquisitions to get to this scale. How can you elect to be an eligible counterparty? Again, this is done on a level of judgment, but you can imagine the process to become an elective professional client to an elective eligible counterparty being more stringent and much more difficult. And you would potentially have to demonstrate a level of expertise and the level of service and transactions you actually provide as a professional client. Earlier, I mentioned it's highly unlikely for someone to move from right to left, to move down and decategorize, we'll say. However, anybody that's regulated by the conduct authority, and if they choose to go down for whatever reason, then the firm that potentially they're dealing with in the past must respect that And then if they become a retail client, then they must go back to providing the highest level of protection to that person, even if you still believe that they have the level of knowledge and sophistication to be treated as a professional client. But if they chose to move down, then you must go back to how you treat all customers fairly from a retail point of view. And that, like I said, is on every single product, whether it be promotion to trade by trade transaction. However, it is rather unlikely for somebody to move down the scale because they would face potentially lengthier transactions, because they'll have to be higher informed about all the said risks. And from an efficiency point of view, when it comes to transactions and business, then that would take a lot longer than beforehand. So as noted, it is highly unlikely for you to go down in the client scale, but you always have the opportunity to do so. When dealing with any client at whatever level, firms should really strive for these 6 different outcomes from a principles of good business and treating customers fairly point of view. And this is really treating customers fairly at every different stage of the relationship or transaction. So if you think from a retail client, what is that journey and what does that journey look like? Well, it could start from seeing an advertisement. So you'll have an advert, then you might start the conversation. So as an advisor, you would inform your customer about the product, you may advise them on their individual needs. Then you've got the acceptance, potentially, and then it goes to post-acceptance. So it could be, if it's a mortgage, the whole implementation of the due diligence of checking customers' affordability and reviewing documentation. And then obviously the lifetime of the mortgage. They are your retail customer for the lifetime of that mortgage, so there's an element of potentially remortgaging, dealing with remortgages or taking people off the mortgage and transfer deeds, so that sort of business. But there's also the element of complaints. So if you go through this process and then eventually it doesn't work out and there's the deal with complaints, which we were discussing last week, then you've still got to treat customers fairly through that stage as well. So if we look at the 6 outcomes we've got here, outcome number 1 being that customers should be confident that they're being treated fairly, and that treating customers fairly is set within the organisation culture and not just from a public relations point of view. It is actually embedded for the interest of the customer, which is a principle of good business. Number 2, the concept of you're selling customers products that they actually need, and not potentially doing it for your own personal gain or gains of the business. The product must be there to serve a purpose. Number 3, that whenever you provide a service, the information must be clear, not misleading, and must be as accurate as possible at the point of sale. For outcome number 4, in the advisory process, that you must take into account the full circumstances of the client. This was noted in one of my previous lectures when I was talking about the fact find. Every customer will go through the same fact finding process to get a full understanding of their circumstances before you advise. Outcome 5 is that whenever you provide a service and the product must perform as prescribed. Obviously, if you're advising on investments, you would fully acknowledge that this is how it's performed in the past. However, the risks are it could not perform as previous. Therefore, a level of expected standards have been delivered. Saying this product may potentially return this. However, there is the likelihood of this downside. So as long as you've explained both sides, then that's what's required and expected. for outcome 5. And then for outcome 6, it's about kind of post-sale barriers. If you're ever going to change the product or withdraw the product, then customers must be informed as much as possible. You may see this yourself as a retail client on savings products when you get that horrible letter or email saying your interest rate's dropping, or you'll potentially get the long letters saying the terms and conditions of your products change from X date, and what does this mean? So all of that kind of element falls under outcome number 6. And as you can imagine, within them 6 outcomes, there is a whole host of regulations, from what we'll cover in part 2 about advertisement, but there's also the kind of record keeping element. There's also the rules and regulations regarding data protection, keeping an eye out on the likes of money laundering or suspicious activity from your customers. There's far too much likes of detail to cover within these lecture elements. Therefore, if you do want to be fully informed of the regulatory standards, then please do have a look at the Conduct Authority's handbook and website. And potentially, if you're going to become a financial advisor in the future, you will of course go through a series of professional body qualifications to fully understand what your requirements are as an advisor and all the levels of risk you have to explain to the likes of retail clients. And to finish off this part, there's a few things we just have to remember when it comes to acting on clients' behalf. And again, that links back to individual principles of honesty, must treat customers fairly and in a professional and integral manner in the interests of the client. But it is also worth noting that a firm, when dealing with a retail customer, they must specify if they're given independent advice. So independent advice is mean likes of whole of market. So if you work for a firm that can potentially advise a range of different products from lots of different firms, you're what's known as whole of market, and you are given independent advice, potential choice between firms. But if you're advisor within the likes of a bank, then you must acknowledge that you're given restricted advice and you're only providing advice on the products that are available at your institution. And this must be made clear verbally in the conversation, but it's also given in the documentation. So one example of regulation is if a customer comes to you and you engage in the conversation and they provide you with an email address in the fact find, then within the first 7 days of the start of that relationship, you must send them in writing the level of the service that you can provide. So as a whole market advisor, within the first 7 days of the first contact, you'll send them a document, which is normally something like the outline of business, or it's called something along them lines. And just in that document, it will say what you can and can't do. And if you're a restricted advisor, then of course that conduct of business letter will say we can only advise you on products that we serve. Thus, if you want to look at firms elsewhere, you'd have to go to an independent advisor. And if you are an independent advisor, then you must provide a comprehensive and unbiased level of advice. You must demonstrate that there's no conflict of interest. And if you are advising on behalf of another institution, then when you provide the client with, say, a product key facts illustration, on that key facts illustration, it will state how much the advisor or the firm will get in remuneration from the bank for getting them your business. When obviously the advisor can't go, oh, well, I get more compensation from if I advise this product, so therefore I'll advise that. You simply cannot do that, and you must demonstrate that you do not do that. Sometimes it's difficult to demonstrate that you're not doing this, but as an independent advisor, when you say this is the product you should have from this institution, what you'd normally do is explain other similar products from other institutions and say why they either can't get access to them, or talk about the process speed, or explain the benefits of the product that you're actually advising them. And if asked, then of course the independent advisor has to be upfront and honest about the fees it charges and where it gets its remuneration from, if it is going to get remunerated from the firm for providing the business from the client. And this concludes part 1. Hello and welcome to the second part of this week's lecture on the conduct of business and the treatment of customers. In this part, we're going to focus on the first element of the customer relationship journey, and this is in the form of advertisements. And as noted in the previous part, future possible customers and clients are also a customer group that businesses need to take care of in the form of advertising fairly. And at the end of this, we'll show you an example of a potential scam sort of tactic in the form of high pressure sales. So, in the regulations from the Conduct Authority, which have statutory power, they enforce that any financial promotion or invitation or sort of enticement must be given in a fair, clear and non-misleading manner, and these link back to the principles of good business and the conduct of authorised firms. A lot of the examples given today will be from a UK perspective. However, advertising rules do differ around the globe, but the majority in the Western economies follow similar advertising strict criteria. And these regulations cover a lot of different mediums when it comes to advertising, predominantly TV, face-to-face and poster adverts. However, there is a bit of a blurred line when it comes to social media. If you're advertising a poster on social media, then this would potentially fall under the requirements as per the regulations because it's a poster. However, the role of the likes of influencers is really becoming a challenge for the regulators. How are they classified, and are they classified as agents, as we noted in the last part, or not? It's also worth noting, if you're an international firm and you're to operate and advertise in the UK, even though your jurisdiction may be outside of the UK, your promotions within the UK are subject to these regulations. So what are they? Well, it's pretty obvious to start with. Any sort of financial advertisement must be fair and clear. And set out here in the bold text are the things adverts must include somewhere. So if it's a financial product, they must first of all acknowledge the charges. So what do we mean by charges? Well, this could be the likes of a yield, or if there's a fee. If it's a savings product, where if someone was to take their money out early and they suffer the penalties, this must also be acknowledged. Any risks that a future client would face with this product needs to be acknowledged somewhere. So for example, on a mortgage advertisement, at the very bottom in bold writing, you will always see the statement, if you do not pay your required monthly payments, your house may be repossessed, or something along that lines. And if there is any promotion or gift to entice the customer, then the conditions of this promotion and offer must be specified. So the classic example in the UK recently is the switching service. If you to switch your bank account, you'll receive £100, for instance. They must specify how you meet that switching criteria. So typically they will say you must get your salary paid in for 3 months and have 3 direct debits set up to this account, and then you'll qualify to receive this £100. And this all must be specified somewhere on the advert. And it's also got to be done in a non-misleading way. So the best places to get misled is when it comes to fees and charges or yields. So if your capital is at risk, they must specify how this may happen. They may specify the amount in a form of percentage that's at risk, or they might potentially say you could lose everything. And that is involving the client. When it comes to yields, yield data in the UK, we tend to use APR, annual percentage rate, when comparing across products. But in itself, that can actually be a little bit misleading. And there's a bit of a challenge regarding this when it comes to savings and debt products. Because on savings, annual percentage rate is fair enough, quite consistent throughout. But on debt products, an APR could be quite misleading, specifically on products that are variable rate, and on longer term products such as a mortgage. For instance, a mortgage, you could be paying a fixed rate for the first 5 years, then after that you'll flip to the bank's standard variable rate. So your rate will be something for the first 5 years, then after that it could be anything, because we don't know what the interest rate will be in 5 years' time. Therefore, they have to base it on the assumption that interest rates stay the same and at the current level. So APRs, mortgages, can be very misleading, but they still need to be provided. And this is where the role of an advisor would have to explain what this actually means. If the charges are complex, so if you've got fees and yields and repayments all involved, the best way to demonstrate this complexity is to give examples. So there may be the likes of a breakdown, an example, which might say, if this is your overdraft and you're overdrawn by X amount for X period of time, this is how the fees and charges will mount up, and then it will give you an overall figure. This is also quite common on the likes of car loans. They'll potentially suggest your deposit, your monthly payments, and then your overall payment figure, and compare that with the list price of the car. So these ways of giving examples is the best way to try and fully inform your customer. And lastly, they must avoid the likes of jargon. So language like subprime or any other financial language that seems quite sophisticated to the general public should not be used. Of course, you should not oversimplify your adverts, but at the same time you must not use complex language that customers just simply do not understand. So avoid jargon. It's also specified in the regulations that promotions should be appropriate, in other words, not over the top, and should be understood by the majority of their target audience. And it is acknowledged that if it is understood by your target audience, then it should also be appropriate for the wider population. In some cases, advertisements are sent to the general public and not targeted. Thus, if it's for the general population, then it must satisfy being clear, fair, and not misleading for everybody. At the bottom of this slide, I've put 2 examples of previous adverts which have actually come under a lot of criticism in the past. Now, can you think why the one on the left is misleading? Now, it has been cropped, so they might have the charges and what have you in the bottom corner, for instance. But why Swift cover was actually found to be misleading is because the person in the advert was a musician or entertainer, and this person was advertising Swift cover. Yet the irony is, Swift cover didn't insure entertainers or celebrities. So quite a lot of people in the music industry that went to Swift cover thinking they'd be covered because they're being promoted by a musician to find out they couldn't be insured. So this led to being misleading. Now you're probably sitting there thinking, why would entertainers not be insured by a car insurance company? And the logic actually is, if you're a celebrity and you crash, well, that obviously impacts the celebrity and potentially their brand, what have you. But also, who else is in the car? So you might have fully comprehensive car insurance, so in the event of a crash, you'd pay out on liability for all passengers. If you're a celebrity and your car's packed with other celebrities, that could be a very big bill. So some insurance companies on car insurance don't insure the likes of celebrities or entertainers for this reason. The one on the right, why do you think this is misleading? Well, it's not actually misleading. However, if we go back to the point before about its target audience here is actually single people, which obviously came under quite a lot of social media criticism in itself, with the slogan, "Are you okay, hun?" It's quite patronising if you're single. But because it was target audience at single people, then what's its relevant to the wider population? And this was actually on the billboards in the London Tube. So it will attract both single people and non-single people. So for that reason, it faced a lot of complaints from the financial regulator, and also did make a bit of a social media storm in the fact that it used the slogan, "Are you okay, hun?" to belittle single people. On this slide, you can see on the right-hand side a very bad example of target advertising on Instagram. Now this again is where it's quite blurred lines, because it's not actually attached to a set company. It's Instagram potentially advertising to you local financial advisors, but the image it's portraying is obviously rather patronising and sexist. But at the moment, under the regulations, who can we actually complain to in this sense? Because the advertisement is just suggesting, click this button and you'll get a link to lots of financial advisors. So is this an Instagram advert, or is there a company behind it? And it will, of course, fall foul of regulations from the FCA, but also the wider advertising standards in the UK due to its sexist nature. And it's really an appalling advert. But what constitutes as misleading customers? Well, there's good examples such as cherry picking. And this is something where you could potentially easily lie with statistics. And there's a great little book called How to Lie with Statistics. I'd highly recommend it to anyone that might do some quantitative research in the future, because it shows lots of examples of how advertisement and any business conduct can potentially lie with statistics. And the best example would be cherry picking data or over exaggerating data. You may see on plenty of adverts which you say 99% of people agree with this, but then the small print will say 99% of the 3 people we surveyed. I know that mathematically that doesn't make any sense, but you get the idea. The big 99% is what people see. They don't actually know the sample was a couple of people in the pub. So that sort of misleading statistic. But also the likes of creating unrealistic expectations, potentially saying immediate timescales when actually the timescales takes much longer. And also there's some appalling adverts that will distract you with their imagery and really take your eye away from the potential risks of the product by giving you a very nice picture to look at, rather than highlighting the real benefits of the product and the risks of the product. So, how do we spot misleading advertisements? Well, the things we should be looking out for is the information that adverts provide. Very often, There's quite a lot of stuff in the small print at the bottom that no one ever reads. However, we can still spot misleading advertisements by a range of characteristics. For instance, do they over-exaggerate on pretty unimportant points? What data do they use? Do they lie with statistics? Do they overinflate a percentage? Do they include all the information regarding fees and potential breakdown structures or examples of how fees are paid? If there's the likes of guarantees or offers or gifts on the product, do they mention the commitment period and how you qualify for said gifts? Are all the risks explained? Let's have a look at the Conduct Authority's website now regarding misleading advertisements. So on the Conduct Authority's website, they'll give you a list of the products that require you to fall in line with the regulations. They also acknowledge that it includes social media postings and on mobile apps, which I said before is becoming a challenge for the regulators. They also give you a long list here of potentially how you could spot anything that is misleading. And then finally at the bottom, they can give you information on where to fill out an online form where you feel that promotion is actually misleading. And there you can see underneath what the Conduct Authority can do with their statutory powers if they agree with the reported advert and believe it is misleading. Then they can go through the following steps. And then for more information on what they can actually do regarding banning, you can have a look on this web page as well. One of our colleagues at Northumbria University, Dr. Jane Brown, conducted her PhD into the advertising strategies behind payday loans, and I have a link to her doctoral thesis here, and the next few slides were provided by Jane, and within the notes to the slides contains a lot of information or literature that she's read regarding the misadvertisement of financial products, but she did focus specifically on the tactics of the payday loans industry, which, as I mentioned in previous lectures, has now really been hit hard by some regulatory sanctions and the requirement for them to reduce their APR. So what you can see right now in front of you is a table from her thesis covering the scales of the APR percentages and potentially why they're misleading. Because APR is annual percentage rate, the problem with payday loans is that they're meant to be for a week long. So potentially you might lend £100, then at the end of the week you pay back 140. So obviously you're potentially paying £40 for a loan, but if you potentially extend that from a week up to a year, this is where it gets the really high APR percentages. That's where they're really difficult to understand. But what you can see from the slide here is the scale of growth in the APR throughout the years and the additional charges that these lenders were potentially charging on their loans. Because their interest rate and their fee structure were very complex, and it did result in customers not fully understanding the level of interest and charges they had to pay and when, and specifically when it comes to defaulting on interest payments, the extra additional costs of that to resolve the defaults really escalated the percentages that customers were charged, and they were really not fully informed of this. And just on some personal advice, I'd highly recommend nobody to visit a payday lender. There is plenty of debt advice services out there, and I would go to your local credit union for localized short-term lending over any payday lender. But financial firms and web-based firms like fintech companies are rather clever in how they potentially advertise on their websites. So here are a few of the literature examples of how we actually read websites. And think about this right now with your own devices. And there's two very common ways that people read websites. One is the F structure. So you'll read across from right to left on the top. But as you go down the page, you start looking over, you stop looking over to your right, and you really focus what's on the left hand side. And because it's the F, that means there's very little looking at the bottom. And this link on the slide gives you more information on this and videos behind the logic. So if you think from this point of view, as an advertisement, where do you want to put the worst news? Well, no one gets to the bottom, and certainly nobody looks at the bottom right. So where do you put the risk stuff or the real examples and information of the fees you actually might get charged on some products? Well, you put them in the bottom right that no one looks at. As noted here, from an Arabic point of view, the F still exists, but it's just the other way around. And also think about this right now for yourself. Whoever looks at the bottom of a website, where do you start? Do you ever get to the bottom? Also, there's what's known as the Z pattern, and have a read of how this potentially works. And this does suggest people do look towards the bottom. However, there's still elements, certainly on the right hand side, that people do not look at. So from that point of view, where again would you put the kind of risk stuff and the stuff you really don't want the customer to see, but focus their attention on the benefits? You'd have benefits at one place, but the risks somewhere else. And marketeers know this. There's a lot of literature and research to be found on this concept. Now let's have a look at some of the payday lenders' websites. These are clippings from previous UK ones, but I would also suggest there's other ones you can look at, the likes of Drafty, Amigo Loans, Peachy, Loan Pig, and so on. But what do you notice about these websites that's on the screen? They look quite playful. You've got sliders on there, and sliders make things look simpler than they are. But what do you notice? If we look at the F, for instance, look on the right hand side of each advert. That's where the fees are. If we look at the wage day advance example, where's the warning at the very bottom? Is anyone looking down there? Or you're just looking at the happy smiley orange thing? And again, there's a slider. Look at the things that are in bold. Apply now. That jumps out at you. The apply now is the same thing as the smiley orange thing. That's obviously done in a certain way. So there's lots of little clever tricks that these websites use. And it's just to be mindful of these and to take into account all the information on the page, specifically when it comes to financial products and commitments that you'll make, rather than just looking at the happy smiley thing. Think about the targeting. This is a classic example which faced a lot of criticism from the advertising standards of Wonga. And who are they targeting? Well, they're targeting young people, but they're using old people as their advert. And that's because in UK culture, we see an older generation as trustworthy. We see them as having money, and they're willing to provide for the junior members of their family. We all used to go to our grandma as children for little sweets and treats, because you know they do this. So when you see this sort of puppetry, then you think, it's friendly, it's my grandma. Therefore you're likely to trust them and fall into that sense of security. But really, we seen 2 slides ago the scale of the APRs they were charging, but yet everybody is really engrossed in the fact that it's a nice old lady puppet that's helping you. not some big corporation that's charging ridiculous interest rates and fees on the loan. So before we mentioned the kind of enforcement power, and we've seen that on the Conduct Authority's website. But just to recap, you can go to the website, see what you think is misleading, we can report it, and the Conduct Authority under the Financial Services Act has the power to name and shame. So wherever adverts are seen to be misleading, then the FCA can actually name and shame and point out the advertisement. And typically, when the FCA name and shame, this is when the media gets a hold of them, and this is where you see the articles on the media channels. But of course, there is a full appeals process, so if the Conduct Authority sees or believes something's misleading, then before the naming and shaming process or any sort of action, the firm can have the ability to represent themselves and challenge any decision and explain their reasoning behind the advert, for instance, in a fair and transparent manner. As well as the name and shaming, there is actually criminal elements to the likes of misadvertising or pressure sales. And this can even include custodial sentences if individuals are found guilty of such practice. And as you can see there, it could land individuals with a fine of up to £5,000 and actually imprisonment, depending on the severity of the mis-selling or the pressure tactics that's used. However, there is a number of exemptions to the misleading advertising regulations and the sales process. This sort of regulatory infrastructure obviously only applies to firms that are regulated by the FCA in the UK's case. So things like private and friendly advice. So I used to be a mortgage advisor. If someone came to me for my advice, I would obviously help them, but in no way can I take money off them to do that because I'm not authorised. So obviously that sort of advice. If you go to like debt management service bureaus or civil servant sort of advice of other charities, then they're potentially exempt from this list. But something that's becoming a big challenge at the moment regarding financial promotion and advice comes from the fintech, financial technology sector, specifically the likes of trading apps. So if you've got a trading app yourself, they might have an educational page. Now, they're using the word educational, but are they really educating you? Are they giving you the level of knowledge they need? Or are they just using this to sell their product? Is their educational page actually educating you, or is it trying to slyly advise you on what to do? Are they oversimplifying things? So the likes of education purposes is really becoming a challenge because it's blurring the lines between giving you advice or actually trying to educate you. But ultimately they're educating you, therefore you can do execution only on their platform. And what I mean by execution only is you make the decision to do that investment. You've not been advised. However, you've just watched their educational page, which is not advisory. So from a regulatory point of view, if you go on this app and make the trade, that's execution only. The platform has given you absolutely no advice and didn't make you make that decision. However, if you watch their educational pages, which shows you how to use their app, and it shows you how to make decisions and how to analyse shares, is that not advice, but subtly? So it's a bit of a blurred line, and a big challenge at the moment is really, is their educational page advice, or is it really educational? I'll let you make that decision. So coming back to the principles of treating customers fairly from the previous part, of course, the fair and clear advertising strategy is an element of treating customers fairly. All customers should be informed whether they're your target audience or a general member of the public that see your advert, and everybody should have access to these said adverts to ensure that everybody is given the same level of advice in a clear and concise manner. And if they're treating customers fairly, then obviously they're working in the customer's interests and they're given the appropriate risk advice as well as the appropriate time to make their own decision. And this will lead us to an example of what you may have seen in the past, or you may have seen in films likes of Wolf of Wall Street, the likes of pressure sales, or what's known as scams like share scams, or typically known as boiler room scams, where this is a firm that's obviously not acting in the customer's interest and they're really cold calling and overinflating and misleading when it comes to investment advice. And essentially this scam is where they want you to potentially sell or invest in companies the likes of penny stocks, and they over exaggerate the amounts of returns that you'll receive, but ultimately you might not actually receive anywhere near what they potentially advertise, or you could potentially lose all your capital. And there is a really, in the UK, strict rules on cold calling from financial firms. You can't actually cold call in the UK if you are a financial firm. It's actually against the law. You can only call, like do outbound calls, if you've had some sort of relationship with them. So your bank can call you, or if you put a request in for someone to call you, then they can call you. But financial firms in the UK cannot cold call. So if you receive a call about share investing, like a boiler room scam, it's instantly breaking the law because you haven't got a prior relationship with them. And as mentioned, the best example of cold calling and boiler room scams is the whole premise of the Wolf of Wall Street on the film, where you can see the call, the office looks something like this picture. I know it's a bit over exaggerated, but they're cold calling their clients to tell them about the next best penny stock. Obviously not giving them all the information, potentially mis-selling the customer, but also they might do this because the firm itself might have quite a lot of ownership in these penny stocks, so therefore people keep buying these penny stocks. It pushes the price up, so the firm who's heavily invested in the shares themselves will benefit from their customers potentially inflating the price, and then the firm could then sell off its own holding in the company to make profit, but obviously that would push the price down, which might make their customers lose out. So this is something where you want to avoid, and certainly from a graduation employment route, you obviously never want to end up in one of these firms. Okay, so if you see job adverts out there for selling of financial products that suggest that you don't need any qualifications, then clearly it's something you need to think head on. Is this really a financial firm, or is it something like this scam? So please do look out for that when you're applying for placements or jobs as well. Typically, if you're working for an advisory firm, it will mention the level of training and qualifications that put you through before getting to the kind of advisory route. You wouldn't go straight into this sort of selling a financial product without the training. So here's just a recap of how potentially these firms operate. Very high pressure sales techniques, cold calling out the blue, which obviously is illegal in the UK. Sometimes they would potentially advertise in papers or online via social media to get interest. And one thing always to be cautious about whenever dealing with a financial services company is if they're pressuring you to make a quick decision. certainly when it comes to a large amount of money. Now, sometimes this was a bit of a challenge as a mortgage advisor because you'd advise the client about a product, but unfortunately that product could be withdrawn at any point in time. So you as an advisor will obviously try and hurry up the decision, but you can't force them to make it on the spot given the size of the commitment. So you have to make the client aware, this is true right now, here's all the facts, here's the key facts illustration. It's up to you to make the decision, but I must warn you, this product could be pulled at any point in time, and that is outside of my control. And just to ensure that you can protect yourself from any sort of scam, I mean, let's be honest, if it sounds too good to be true, it probably is. Be very cautious when they overinflate high returns. Make sure that any sort of business provides a conduct of business email. So if they haven't contacted you within 7 days to set out their conduct of business and what they can and can't do, then they're falling foul of the regulations. Keep an eye on the FCA's website for examples and warnings of said firms. In the Blackboard site and the TLP for this week, I've provided a number of websites regarding scams, Fraud Awareness Week. But ultimately, when it comes to financial services, do act with caution. And as noted, the directed study, certainly have a look at the Conduct Authority's website regarding the treatment of customers, the likes of misleading advertisements. Have a look at the notes of this presentation, which contain a lot of literature regarding misleading advertisements from Jane Brown's doctoral thesis. Do have a look at the fraud awareness website on the Teach and Learn plan, and also the practice question 2 is now available for you to try, and I'll provide the answer later in the week. Thank you.